You're 17 or 18 years old, someone puts a piece of paper in front of you, it says you agree to borrow tens of thousands of dollars. You sign it, and nobody in that room explains what you just did to your future. Not your counselor, not your school, not the smiling financial aid person who says, "Don't worry, everyone does this," which, by the way, is not financial advice. That is peer pressure with a FAFSA login. That's student loans. And today we're going to cover everything they didn't tell you before you signed. A student loan is money borrowed specifically to pay for education, tuition, housing, books, fees, and sometimes, let's be honest, a textbook that costs $285 because apparently the pages were printed on endangered tree bark. Sounds straightforward. You borrow money, you go to school, you graduate, you get a job, you pay it back. Cute little bedtime story, except there are details buried in that agreement that can affect your life for decades. There are two main types of student loans: federal loans from the government and private loans from banks and lenders. Federal loans are usually the better option. They often come with more flexible repayment plans, income-based options, forgiveness programs, and protections if life decides to throw a folding chair at you. Private loans usually have fewer protections, and they can be much less forgiving. Basically, federal loans are like a strict parent. Annoying, but there are rules. Private loans are like borrowing money from a raccoon in a suit. Technically legal, but emotionally suspicious. If you have both, private loans are usually the ones you want to attack first, especially if they have higher interest rates. Now, within federal loans, there are two more types: subsidized and unsubsidized. Subsidized loans are the good ones. The government pays your interest while you're in school, you graduate, and you owe what you borrowed. No little interest gremlin growing in the corner while you're trying to pass chemistry. Unsubsidized loans are sneakier. Interest starts accumulating the day you take them out, not when you graduate, not when repayment starts, the day you take them. So if you borrow $10,000 unsubsidized during freshman year, by the time you graduate, you may already owe more than $10,000 before you've made a single payment, which is insane. You were in a dorm eating microwave noodles and crying over a discussion post, and somewhere in the background, your loan was multiplying like financial bacteria. That interest can eventually capitalize. Capitalized interest means unpaid interest gets added to your principal balance. And then future interest is charged on that bigger balance. In normal human language, that means your interest starts collecting interest. Debt gets a baby, and then that baby gets a job, and that job is ruining your life. That is one of the biggest things nobody explains clearly at orientation. Orientation is like, here's the dining hall, here's the gym, here's how to join clubs. Meanwhile, the loan agreement is in the corner wearing a trench coat. So why do people take student loans at all? Because for a lot of people, they're the only path to a degree. And for certain careers like medicine, law, engineering, dentistry, or other licensed professions, education is not optional. It is the price of entry. You cannot just walk into a hospital and say, "I watched 3 YouTube videos on anatomy. Hand me the scalpel." Society frowns upon that. Student loans can be a tool. Federal loans especially can come with real protections. There are income-driven repayment plans that base your monthly payment on what you earn. There is public service loan forgiveness for people who work in qualifying government or nonprofit jobs. There are deferment and forbearance options if you lose your job, go through hardship, or need temporary relief. So student loans are not automatically evil. They can help people change their lives. They can give access to careers, income, stability, and opportunities that would otherwise be impossible. The issue is that most 18-year-olds are not thinking about return on investment. They're thinking, I got accepted. They're thinking, this school has pretty trees. They're thinking, hey, maybe if I move away, I will become a completely different person who drinks water and folds laundry. No one is sitting them down and saying, okay, but what will your monthly payment be when you're 27? And that is the problem. Let's talk about why student loans can become dangerous. Student loan debt is much harder to get rid of in bankruptcy than many other kinds of debt. Credit card debt can often be discharged. Medical debt can often be discharged. Student loans are different. In many cases, you have to prove something called undue hardship, which is a much higher legal standard. So, no, it is not as simple as saying, Oops, I declare bankruptcy, like Michael Scott, standing in an office yelling into the air. The debt does not just vanish because you said it confidently, and the effect goes way beyond the monthly payment. Student loans affect your debt to income ratio. That means when you try to buy a house, the bank looks at your income, your debt, and your monthly obligations. Then they decide how much house they think you can afford. And your student loans are standing right behind you, like, don't forget about me. It can affect your ability to qualify for a mortgage. It can affect car loans. It can affect your credit score if you miss payments. It can affect renting an apartment. And it can affect whether you feel safe taking a lower paying job, starting a business, moving cities, getting married, having kids, or taking any risk at all, because every month the loan is there, just sitting in your inbox, existing like a toxic ex who learned accounting. People stay in jobs they hate because the salary covers the loan payment. People delay dreams because they cannot afford to be unstable. People choose the practical option over the meaningful option because debt turns every decision into math. And math, as we know, has been bullying people since the third grade. But what happens if you don't pay? This is where it gets serious. If you miss enough payments, your loans can become delinquent and eventually go into default. Default is not just a scary word lenders use to sound dramatic. Default has consequences. Your wages can be garnished. That means part of your paycheck can be taken before it ever hits your bank account. So you open your direct deposit expecting one number, and the government says, actually, we packed you a smaller lunch today. Your tax refund can be seized, your credit score can be damaged, and once your credit score is damaged, everything gets harder and more expensive. Renting an apartment, getting a car loan, getting approved for credit, sometimes even basic financial stability. And yes, in some cases, federal benefits like Social Security can be offset for defaulted federal student loans. That one shocks people. Because imagine being older, retired, trying to enjoy your little crossword puzzle and oatmeal, and your student loan from 1987 is still knocking on the door. Ignoring student loans is not a strategy. It is the financial version of putting a blanket over your head because you heard a noise in the hallway. I respect the instinct, but the monster has your Social Security number. So, what are the alternatives? Because student loans should not be the automatic default for everyone. One option is community college for the first 2 years, then transferring to a 4-year university. Same bachelor's degree at the end. Potentially way less debt. And no, community college is not less than. That is a lie people tell because they want to pay $70,000 for the same freshman English class. A transferable class is a transferable class. Your future employer is probably not going to ask whether your intro to psychology lecture had ivy on the building. Another option is trade school or vocational training. Electricians, plumbers, HVAC technicians, dental hygienists, radiology techs, respiratory therapists. Many of these careers can pay well, require less time in school, and cost far less than a traditional 4-year degree. And let's be honest, when your air conditioner breaks in July, nobody is looking down on HVAC technicians. They are treated like emergency room surgeons. Scholarships and grants are another option. Free money that does not need to be repaid. Most people apply to 2 or 3 and then quit. The students who win more money often apply to dozens. It is annoying. It is repetitive. You will write the same essay about leadership so many times you start to question if you have ever led anything in your life. But free money is free money. There is also employer tuition reimbursement. Some companies will help pay for your degree while you work for them. You get education, they get a more skilled employee. You reduce what you have to borrow. And then there are military education benefits. That is not for everyone. It is a serious commitment. But for the right person, it can be life-changing. The bigger point is this: college is not one path. There are routes, there are discounts, there are transfer plans, there are work programs, there are scholarships, there are certifications, there are ways to get where you want to go without automatically signing the largest loan possible because someone handed you a packet and said, this is normal. Normal does not always mean smart. Sometimes normal just means a lot of people made the same expensive mistake. Now, if you already have loans, what do you actually do? Step 1. Know exactly what you owe. Log into studentaid.gov. Find your federal loans. Know your balance. Know your interest rates. Know your loan servicer. Know which loans are subsidized, unsubsidized, plus loans or private loans. Most people do not know these numbers. They just have a vague emotional sense of doom. And while doom is valid, it is not a repayment plan. Step 2, choose the right repayment plan. The standard repayment plan usually pays loans off in 10 years. Income-driven repayment plans can lower your monthly payment based on your income and family size. If you work in public service, government, or certain nonprofit jobs, look into public service loan forgiveness early. Not after 9 years and 11 months. Early. Because the rules matter. The loan type matters. The employer matters. The payment plan matters. The paperwork matters. PSLF is not a casual, vibes-based forgiveness journey. It is paperwork with consequences. Step 3, pay more than the minimum when you can. Every extra dollar toward principal reduces the amount that interest can grow on. Even small extra payments can help over time. It does not have to be dramatic. You do not need to sell a kidney or live in a basement eating plain oats. But if you can throw an extra $25, $50, or $100 at the loan consistently, it can make a difference. Step 4, be very careful with refinancing. Refinancing private loans can sometimes make sense if you get a better rate. But refinancing federal loans into private loans means giving up federal protections. That can include income-driven repayment options, forgiveness programs, deferment options, and other safety nets. So before refinancing federal loans, think very carefully. Do not trade protections for a slightly prettier interest rate unless you fully understand what you are giving up. That is like selling your umbrella because it is sunny at noon. Cute decision. Terrible thunderstorm plan. Step 5, do not ignore your servicer. I know, loan servicers are not exactly known for giving warm, cozy cottagecore energy. But open the emails, read the notices, keep records, take screenshots, save confirmation numbers. If you call, write down the date, time, and who you spoke to. Because if something goes wrong, I swear someone told me this, over the phone is not as powerful as documentation. Become the annoying, organized person. Future you will be grateful. Here is the honest truth about student loans. They are not automatically good or bad. They are a tool. And like any tool, in the right hands, for the right purpose, with the right plan, they can build something. In the wrong situation, they can do damage. A hammer can build a house. It can also break your toe. The hammer is not evil. But you should probably know what you are doing before swinging it around your financial future. The problem is that the system asks teenagers to make adult financial decisions before they have adult financial experience. At 18, you may not be trusted to rent a car, but you can borrow enough money to financially haunt yourself until your knees start making sound effects. That is wild. And if you already signed, I do not want you to feel stupid. You are not stupid. You were young. You were trying to build a life. And a lot of adults made the process sound simpler than it really was. That is not your fault. But now you know more. You know what interest is doing. You know why unsubsidized loans are different. You know what default can lead to. You know there are alternatives. You know repayment plans exist. You know refinancing is not always the genius move people make it sound like. And that knowledge matters. Because the people who get hurt the most are often not the people who borrowed. They are the people who borrowed and never understood the rules. So if you have student loans, do not panic. Get the numbers, make a plan, ask questions, read before you sign, and please, for the love of your future bank account, do not pick a school just because the dorms have exposed brick and the campus coffee shop has oat milk. This is your life, not just your college aesthetic, not just... If this helped you understand something nobody explained before, subscribe because we do this every week, and drop a comment. What do you wish someone had told you before you signed for your loans? I'll see you in the next one.